Obviously, we see a lot of good growth there, but it's also great for.
What do you prefer? Football? Do you like some American sport? What do you fancy?
Well, we look at opportunities and see what happens. But
Mohammed, thank you so much for being with us. We won't get the breaking news on which sports team you're after. But anyway, the Executive Chairman, Mohammed Al-Hadi there of Investcorp on infrastructure investing here in the US and private credit markets. Coming up, the crypto world. We're watching Sam Bankman-Fried's sentencing.
We suffered a lot of damage to trust in the end of 21 and 2022. And getting that behind us is a good thing, period. I wish SBF well.
Our conversation next on Bloomberg. Good morning from New York.
We
It's official, the Bears have capitulated according to John Arthurs. These equity markets have put in 5 months of gains. SPOOs are up 10%. We haven't seen a day of where we've drawn breath of a drawdown of over 2%. I want to show you the performance in the Magnificent Seven and the bifurcation of Magnificent Seven. I give you NVIDIA, which is resplendent. Tesla, however, is down, and Apple. These are the laggards of the Magnificent Seven. And that is why people are saying we need to perhaps reconsider the construct of tech going into the latter part of the year. Maybe it is an opportunity to buy those dips. Let's stay to play on the equity markets. Your schedule, your trading diary is this. UMich sentiment at the top of the hour. We're also waiting for the sentencing of Sam Bankman-Fried, and the US bond market closes at 2 p.m. Eastern. Tomorrow, we will end the week with the US PCE data, and the Fed Chair, Jay Powell, speaks. You've heard Waller. What will Powell push back with? Okay, that is it for me and the team here. It is Good Friday tomorrow. We have a day off. We'll see you on Monday and do it all over again.
All right, we are 30 minutes into the U.S. trading day on this Thursday, March 28th. Here are the top stories we're following. The last trading day of the quarter and the S&P 500's best start to a year since 2019. Everything from stocks to gold to Bitcoin hit new records this quarter. Momentum is a powerful force. Rebuilding the Baltimore Bridge. Officials estimate that the total cost will be at least $2 billion. The CEO of CRH, America's largest building materials company, joins us to discuss. And awaiting Bankman-Fried's sentencing. The final chapter of the FTX case concludes today with Bankman-Fried set to be sentenced for stealing billions of dollars from customers. We'll preview what his prison time might look like. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets on the final trading day of the week and the quarter, and it's pretty quiet. We've been getting used to that, but it is green. You take a look at the S&P 500 up about 0.1%, pretty small moves altogether here. It's the same thing, too, if you take a look at the NASDAQ 100 and your big tech stocks, currently up about 0.1%. And this is interesting because it was the same story yesterday where you do have small caps outperforming. Of course, the Russell 2000 up by about 0.3%. We do have some economic data to sink our teeth into. Let's get right to Bloomberg's Mike McKee.
Well, if you want to trade higher, Katie, you can pin your hopes on the numbers we just got from the University of Michigan and also pending home sales from the National Association of Realtors. Michigan sentiment comes in higher than expected and higher than last month, 79.4. That's up from 76.5. The current conditions index is 82.5, up from 79.4. And the expectations index rises to 77.4 from 74.6. Now, the number that the Fed is watching is inflation expectations, and in both cases, both measurements, they go down. Good news for the Fed. One-year inflation seen at 2.9%, down from 3%, and the 5 to 10-year figure, 2.8%, down from 2.9%. In terms of pending home sales, a little bit of a pickup, a 1.6% gain for the month of February. We've been getting anecdotal reports from realtors and home builders that things are better. Last month in January, we were down 4.7%. So some improvement there and some improvement in the way people are feeling about the economy, Katie.
Yeah, and you can see the market reaction. Again, quiet moves, but the direction of travel seems to be higher for stocks, lower for yields. You mentioned inflation expectations. And speaking of inflation, I understand that you're actually working tomorrow.
Yes, send me your chocolate eggs. I'll sell them on the black market with the cost of chocolate these days.
There you go.
But yes, we have the PCE inflation numbers tomorrow, which obviously are key to the Fed. They will be out at 8:30 tomorrow morning, along with income and spending, and I will bring all that to you on Bloomberg Radio. And then Jay Powell is speaking tomorrow, 11:30. We'll see what he has to say about those numbers and about what Chris Waller said last night, that there's no rush to cut rates.
Yeah, it'll be interesting to see if Powell also agrees and also messages that tomorrow. Good luck with that. Bloomberg's Mike McKee, thank you so much. Let's turn now to the broader equity markets. I'm pleased to say that joining us now, we have Shana Sissel. She is Bonrian Capital Management CEO and founder. So let's talk about this equity market, because the S&P 500, it's up roughly 10% year to date. That is one of the best first quarters in several years. And Shana, you make the case that this is really earnings led.
Yeah, its fundamentals have really been driving stock performance, and that's what you want to see. We've had a long time where that hasn't been the case at all, that macro factors have been driving it, but we've had really strong earnings, and the market's starting to pick winners and losers and based on earnings. So yes, its fundamentals are driving stock performance, and that is a good thing if you are a fundamental investor.
And Shana, it's interesting, I mean, because coming into the year, the bear case, or the more subdued, not quite bullish case, was that you were going to see earnings struggle a bit here, that, okay, 2023 was better than feared. How much can that really continue that momentum? What do you think actually has not only had earnings hold up, what about this macroeconomic environment has actually fueled them forward?
I think the reason people thought that earnings would not be as good is because rates were high. And there was this feeling that we would have some slowdown in the economy, and we haven't seen that. And so that has been reflected in how companies are performing.
And there you go. And like you said, that is creating winners and losers. We're going to get into specific names in just a bit. But at a sector level, what's the broad brushstroke sort of paint here about who's a winner in this environment where maybe rates aren't coming down as quickly as had been consensus?
Well, clearly technology. Technology has been a big winner. You've seen the semiconductor chips. You've seen a lot of technology stocks do very, very well. You've seen some positive movement in some of the industrial names as well. There hasn't been a sector that I would consider like a big time loser, except maybe utilities or anything that's dividend driven. When you have higher rates, having a good dividend yield's not as important. But you've seen some broadening here. Healthcare is an area that's very interesting. It's lagged a little bit, but started to do a little better more recently. But technology has been the biggest winner, and I don't see any reason why that would change anytime soon.
An interesting point, too, on dividends, that for some of those high dividend payers, when you have bonds yielding what they are, maybe that doesn't look quite as attractive here. But let's talk about the Fed, because we do have PCE tomorrow. Mike McKee has to work tomorrow. And I guess there's a risk here that the Fed is more hawkish, again, than has been thought. But we've already seen a lot of cuts get priced out of this market. Do you think that the risk of a more hawkish Fed is already priced in?
I do, but I actually have the opposite concern. I actually think the Fed is being a little too dovish, because if they were truly hawkish and they looked at this economic data, there would be no cuts this year. And even the Fed is saying they expect to have 3. In fact, not to stir the pot too much, but I would argue that if the economic growth numbers continue to come in as they are, even with rates where they are, I would argue that the Fed might need to continue to raise rates. Now, I know that's controversial and it's definitely stirring the pot, and I do not think it'll happen, but I would argue that they probably should be thinking more like that than in how many rate cuts they're going to have this year.
Shana, stir away, because I think it's a really interesting point, and it's a question that I've asked that, okay, you have economic growth holding up. At the same time, of course, you have inflation coming down. Why are we talking about rate cuts? And I know that you think that there's actually a risk that maybe they hike, if we can voice that into the universe. But why do you think the Fed is talking about rate cuts? What explains that real desire to cut rates this year?
I think the Fed and the markets have gotten a little bit drunk on the punch that the Fed has been giving them from the punch bowl for years now. We're so used to this zero interest rate environment that it's just seems absolutely insane that we wouldn't start to cut now that we're, 4.5%, 5%. But if you look back historically, these rates are not high by any stretch of the imagination. It's just, I think the Fed, we're in an election year. I know people like to say the Fed's not political. I don't know. They can be. I think that just generally speaking, the Fed wants to cut rates. They want to do things that are going to have a soft landing. Raising rates is going to increase the likelihood of a recession. And I think the Fed really wants to take a victory lap here.
Yeah, for better or worse, I think that we're going to be having that conversation pretty often the next couple months heading into November, whether or not the Fed is political. But one quick question before we go to break. Probably the most surprising all-time high to me this year so far has been what's been going on in Bitcoin, because that seemed to really be born of that zero interest rate environment. Now, of course, we're back at all-time highs, close to all-time highs for Bitcoin. What's the bull case here? Is it just increasing adoption with these spot Bitcoin ETFs?
That's exactly it. You're able to have a large group of individuals who would never have considered investing in Bitcoin now investing in Bitcoin. And you have two things that kind of make it so that pushes the price up. Number one, the amount of tradable Bitcoin is small. As a percent of the market cap, it's only about 20 to 25% of total Bitcoin trades regularly. So you have to consider that. The second thing is the halving, which happens next month, which is also going to push the price up. And if you look at, IBIT is the most successful ETF launch ever. And then if you look at who's 2 and 3, they are would probably have been the best ETF launch ever, if not for IBIT. So people are clearly adopting these ETFs, makes it easier to own Bitcoin, and people clearly want to. It's a risk-on environment.
Yeah, the net inflows into that group of U.S.-listed spot Bitcoin ETFs has been pretty fascinating to watch. Shana, stay with us. We're going to take a quick look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Jess Menton sitting to my left. What is going on with Supermicro Computer?
Well, if you look at this last trading day of the quarter, so this is actually the best performing stock. And also I have to give the caveat, it was recently added to the S&P 500, so it didn't contribute all the gains this quarter, but nonetheless, you see this stock up about 260% this year alone. It's also up more than 20-fold over the last 2 years. It has a $50 billion market cap. If you look over at JP Morgan analysts, they actually still see some more room to run. They initiated coverage with an overweight on that stock, and then also with a $1,150 price target on that. But of course, you can't forget NVIDIA, right? So it's the second best performing stock in the S&P 500 this quarter. It's up about a little bit more than 80% year to date.
It's nothing. It's nothing.
And also up more than 140% since last May.
Not too bad, but yeah, Supermicro Computer, the fact that it started the year as a small cap, now it's $50 billion, amazing.
Look at it now.
That's the best performer. What's the worst performer this quarter?
Tesla, down almost 30% this quarter alone. So this is a stock that has been, as we know, under pressure. And especially next week, we're going to get another update on that first quarter delivery numbers. So I know traders are very eager to watch that. If you talk to some of the stock bulls for this stock, they do think that some of the issues we've seen with deliveries could be temporary, but you have seen a number of analysts just this week alone from Mizuho and others beginning to downgrade that stock. So that's going to be something really key. And just in general, if you look at this, it's raced over $350 billion in market value since touching that 52-week high back in July. So it's going to be really key going into next week, seeing what those delivery numbers look like.
Yeah, we'll see if this is a one-off bad quarter, but earnings season never ends, and we did have earnings this morning.
We do. So we do have JP Morgan reporting on April 12th, a couple weeks away, but Walgreens reporting this morning. So WBA is a ticker symbol on this. If you look at that stock, just marginally higher, but it is down almost 20% year to date. If you compare that to where the S&P 500 is, the S&P is up about 10%. So we know that so far this quarter. So strong quarter for the S&P, but when you look at Walgreens, some of the support for the stock today, and you know this, Katie, anytime there's some sort of strategic review that comes along with a company, you do see traders eager to see that happen. So CEO Tim Wentworth really reiterating what we've heard and already known already from this company. So they did tighten their outlook. They did beat quarterly estimates for second quarter profit and revenue, but the company did cite a tough retail environment. Also, it had a major write-down when it came to the value of its Village MD primary care unit. So that was another particular issue there. But when it comes to those cost-cutting efforts, that's what investors are eager to hear more about and see how this follows through as far as the cost-cutting efforts and around potentially $1 billion over the course of the next year. But we'll have to see as more executives come into that company how this all plays out.
Great roundup, as always. Our big thanks, of course, to Bloomberg's Jess Menton. Now coming up, Home Depot building out its business as it tries to woo professional contractors. We'll have the details on its new deal next. This is Bloomberg. Well, Home Depot announcing today that it will be buying building materials company SRS Distribution for more than $18 billion. The home improvement retailer is beefing up its professional services business as it makes a push to win over contractors, roofers, and other building professionals. Bloomberg's John Edwards joins us now with more. And I know Home Depot. I don't know SRS, of course. That is a private company. What does Home Depot see there?
They see an opportunity to really maximize their presence in that professional market, which is so important to them. And they're already doing better than Lowe's, their main competitor. Home Depot gets about 50% of its revenue from professionals, and Lowe's gets about a quarter of its revenue there. So Home Depot just wants to build on that lead, basically, and SRS is a big way to do it. It's a huge player in roofing, also involved in materials for landscapers and pool contractors. So this is just another way for Home Depot to ramp up its exposure to that lucrative professional market.
And it's good perspective too, because you think Home Depot, and often the conversation is about those DIY renovators at home, but the professional side obviously hugely important to them.
Yeah.
Let's talk about the price tag, because $18.25 billion, that is quite a chunk of change.
Yeah.
But you take a look at Home Depot shares, they're only off about 0.6%. It seems like the market may be okay with this.
Yeah, exactly. And I think it's because it really confirms the trend, and it confirms what people want to see out of Home Depot, which is, getting more exposure to that professional market. So, even though when we think of Home Depot, we see the commercials and we think of, going down and, getting stuff, in the carts. But what they're really focused on is those professionals who buy big ticket items, and a lot of them all at once. And so that's why the market seems to like, pretty well what it's seeing here.
Yeah, it seems like the market and Home Depot are aligned on where the opportunity set is.
Exactly.
John Edwards, always great to see you, of course. Our thanks to Bloomberg's John Edwards. And we are back now with Shana Sissel. She is Bonrian Capital Management CEO and founder. And Shana, we were talking very high level before the break, but of course you do invest in individual stocks. And before we get into some names here, I'm wondering what your process looks like. How do you identify specific companies when you're looking to invest in a single name? Because looking at your list, I see tech, I also see energy. It's a real broad mix here.
So I'm going to tell you an answer that you probably have never heard before.
All right.
And a reflection of the background of how I came up in the industry. So my background is that I worked mostly in manager research, meaning that for the last 15 plus years, I research individual strategies, mutual funds, hedge funds, things of that nature. So the way I get my stock ideas is when I sit down and talk to portfolio managers, I hear them tell their stock stories. And so I will look through some of the portfolios of my favorite managers who I have the greatest respect for, and find names that seem interesting to me from a story perspective. I'll talk to them and see why they and their analysts tend to like them, and then I'll do my own work based on, the feedback I've gotten. And that's how I narrow my list down. Now, I do my own work after the fact and try to make sense of the story above and beyond what I've been told. But most of my ideas come from looking at people that I truly respect's portfolios and what they own.
No, that makes a lot of sense, and I appreciate the clarity there. And it's interesting, this story-led approach, rather than, I talk to a lot of people who, for example, use a screen, they look at valuations first, price to book, et cetera, but it sounds like you really start with the narrative and then go from there.
Yes, I started my career at Fidelity Investments. So I worked with Will Danoff and Peter Lynch, and they are story people. Will always likes to talk about how most of his best ideas come from paying attention to what kids are doing. There are stories about Peter walking through downtown Crossing and walking into stores and asking salespeople what's selling. They were story people. So I grew up in an environment where the folks that I respected most, that's how they approached it. Now then they go and look at the PEs and that kind of thing, but they don't start screening that way. They look at what the trends are, what they're hearing. They'll sit in on meetings with management from other firms and hear about competitors and start with the story and then look at the fundamentals. And so that's kind of where I come from too.
Well, let's talk about one of the biggest stories out there. That, of course, is AI, and that, of course, is NVIDIA. Of course, NVIDIA has just seen such a fantastic run. We were just talking earlier with Jess. It's up, 80% this year alone. It's only been one single quarter. What is the continued momentum here? Because I have to imagine all of NVIDIA's competitors are really trying very hard to take some of that share.
Well, they don't have a lot of competitors, and that's part of the story, is that there aren't a lot of folks that are doing what they're doing and in being as innovative as they are. The other thing is, once you start using NVIDIA chips, you tend not to move unless there's a reason, right? And since they already have the dominant position, unless NVIDIA does something to screw that up, it's going to be hard for another player to come in and take share. They have more demand than they can keep up with supply-wise. That, again, is a tailwind to the stock. Now, I would argue that that is actually a risk as well, because as I just said, they have to execute perfectly in order to ensure that they don't have somebody in and start to take share because they can't meet demand. But they have done that. And so, those are the reasons I really like the stock. We're only in about the second inning of AI. I've liked the stock for a long time. You want to talk stories. I got excited about NVIDIA back in 2001, 2002, when I started following the stock, when I first got into the industry, because of the gaming chip and the graphics. And I remember watching my brother play video games and being in awe of the quality of the graphics. That is what got me looking at NVIDIA, and that is how I followed the stock ever since. But today, it really is about having that dominant share and executing really, really well.
And I mean, it's a good reminder too. NVIDIA has been around for decades. This is not a new company just coming out of the gate. So that's the NVIDIA story, and it definitely makes a lot of sense. On the other side, though, sort of the, I don't know if you want to call it one of the spiritual opposites of what we're seeing in AI, you do have an old school energy company. We're talking about Diamondback Energy. We have just about a minute, but what's the story there? Because I feel like some of these energy names have definitely been left behind.
Well, we've seen some changes. There's not as much emphasis on EV. Goldman just came out with a note saying that hybrids, where it's at in terms of cars, we're not seeing that there's less demand for gasoline and other types of fossil fuels. Diamondback Energy has this huge advantage in that they can get and be profitable with oil prices being at $50 around that point, which is better than most of their competitors. So they have very good margins. They're also potential for to be acquired from some of the larger players out there because they have such good margins, and they're able to take advantage of what's going on in the marketplace now, where we're starting to see this reversal of people moving back to the fossil fuel world, understanding that we're not ready to shift away.
All right, Shana, always great to speak with you. Have to leave it there. Our thanks to Shana Sissel, Bonrient Capital Management CEO and founder. Still ahead, social climbers. That's up next. This is Bloomberg. right, it's time now for Social Climbers to look at the stocks making waves on social media this morning. First up, Carnival warning that its 2024 earnings could take a $10 million hit because of the Baltimore Bridge collapse. Cruise operator said it will temporarily move its Baltimore operations to Virginia. Next up, Estee Lauder getting a glow up after an upgrade. Bank of America raising its recommendation on the personal care giant to a buy, saying that earnings have bottomed. And finally, we do have Coinbase making the social rounds after a federal judge in New York ruled that the SEC can move ahead with its lawsuit against the crypto trading platform. The SEC alleges Coinbase illegally operates as an exchange under federal securities laws. Coinbase argues the SEC has no power to regulate them. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, rebuilding the Baltimore port, we're going to be speaking to CRH. Well, rebuilding the collapsed Francis Scott Key Bridge in Baltimore, it's likely to cost over $2 billion, according to federal officials. Here to talk more about what it will take to repair this vital port is Albert Manifold. He is CRH CEO, and CRH, of course, is the world's largest building materials company and the largest road builder in the U.S. Albert, great to have you here. So we're talking about a 1.6 mile long bridge. That works out to about 2.6 kilometers. When you think about that, does $2 billion or so sound reasonable from your seat?
Look, first of all, this is a terrible event, and really, first of all, our thoughts must go to the families of those who lost their lives. This was a tragic accident, and one really has to reflect on what actually happened here. These are enormous cargo vessels. The vessel we're talking about was 1,000 feet long, and in fact, fully loaded as it was with containers, it weighed twice the weight of the largest aircraft carrier in the world. Now, no bridge could withstand being hit by that. In saying that, of course, people are just trying to make an assessment of actually what happened, and it's going to take quite some time before they make an assessment as to how it will be rebuilt. So we're too close to the situation at this moment in time to make a proper evaluation of it. But I know that from seeing situations not like this in the past, where we've had to do very large, quick reconstructions, if you put the time and effort and the design specialists involved and work getting modular type construction in place, one can build back these bridges very quickly in a more sustainable way and in a safer way as well.
And Albert, I mean, I think it's a really important point, just the size of scale that we're talking about. Actually, when you take a look at some of the side views of the bridge compared to the actual vessel that we're talking about, the ship, it's just really striking. So I appreciate your perspective on that point. I want to talk about the cost of raw materials right now. Obviously, you think about what goes into actually rebuilding something like a bridge. I mean, what kind of inputs are we talking about, and how do those prices look on things such as concrete, for example?
Well, look, there's been a significant increase in energy costs over the last 3 or 4 years, as indeed in all costs, and that has flowed through into construction materials as well. In saying that, construction materials are only a small part of the overall cost of actually building back major infrastructure, roads or bridges, or indeed whatever it might be as such. There's, of course, the labour involved, the manufacturing, the materials involved, and of course the civil works and the preparation of the site itself. So all told, it is expensive, but again, remember, you're building infrastructure that lasts 50 or indeed 100 years.
Good points there. Let's talk a little bit about infrastructure beyond, of course, just this bridge. When it pertains to the U.S., of course, I know that you see substantial opportunity for CRH when it comes to U.S. infrastructure. How are you planning to seize on that? Of course, I know that you recently switched your listing to the U.S. Was that part of the plan?
Well, look, CRH has been present in the United States for over 35 years, and we're the largest building materials business in all of the United States. In fact, the next 4 players down, we're larger than those all 4 combined. So we are a very large business in the US, and we're very well positioned to benefit from what is a generational stimulus package that we're seeing in place. We've got the IIJA Act, the IRA, the CHIPS and Science Act. All of these are supporting significant construction spend as we rebuild back up the critical infrastructure that would help drive the economic growth in America in the decade ahead.
Well, to your point, I mean, you've been involved in the U.S. for decades, but I mean, to ask it another way, does being a U.S. listed, primary U.S. listing company help you seize upon that in any way?
Well, look, we moved our listing in September of last year, but at that time, 75% of our profitability has come from the United States, and that's going to continue to grow in the years ahead. It just seemed a normal part of the evolution of our business to move our listing over to North America. And of course, as we've seen, we had a very strong finish to 2023. It was our 10th consecutive year of profit growth and margin growth, and that's continued into 2024. So I think we're well set with very good tailwinds. Again, being the largest building materials player here, with that type of support coming through for infrastructure, it bodes well for our business, because infrastructure is 50% of total construction here in the United States.
So the United States, obviously a meaningful contributor to your bottom line, but being in the U.S., I'm curious, has it helped familiarity with U.S. investors? Because I take a look at CRH shares, for example. I know that you recently hit an all-time high. Does being listed on the New York Stock Exchange really help U.S. investors know who you are?
Of course it does. I mean, I would say that to some extent, we're the largest company you never heard of. Our total market cap is over $60 billion. And we did move over to the United States because this is where our locus of the focus of our business actually is now. And as we go forward, we think that as we get our message out there, because as I say, we are the largest player in building materials, a very significant beneficiary of not just infrastructure spending, but also this onshoring and reshoring of critical manufacturing back to the United States is a very significant bonus for our business going forward. And again, we've outperformed all of our peers over the last number of years. I think that is resonating with the investors, particularly not only with the returns we generate, but over the next 5 years, we will generate about $35 billion of free cash flow. About $25 billion of that will be invested in growing our business in what, as we see, is a very significant growth cycle for construction in the United States in the years ahead.
Could the other portion there be used for acquisitions, for example?